Okay, let's dive right in. It is Friday, January 23rd, 2026. And if you were watching the markets this morning, you probably saw something that, well, it just doesn't make sense on the surface.
Not at all. It's one of those headlines that makes you check if your app is bugging out. A real head scratcher.
Right. So let's just lay it out. Booz Allen Hamilton, the huge government and defense contractor, a name that's been around forever, they reported their Q3 earnings.
And the top line number was, to put it mildly, not good.
Not good is an understatement. Revenue was down over 10%. They missed Wall Street's revenue target by, what, over $100 million?
A significant miss, yeah. And in 99% of cases, a miss like that, a double-digit revenue drop, the stock gets absolutely crushed.
It's a bloodbath, usually.
Yeah.
But that is not what we saw today, not even close. The stock is actually trading up.
And not just a little bit. It was up almost 7% in the pre-market, and it's been holding strong.
So that's the big question we're tackling in this deep dive. Why? Why on earth is the market rewarding what looks like a terrible quarter?
It's a fantastic question. And I think the answer, which is what our sources are pointing to, is that the market is finally catching on to a massive identity change that's been happening inside Booz Allen.
And that's our mission today. We've got the earnings call transcripts. We have some really deep investigative reports. We have analyses on their new tech partnerships. And all of it, when you put it together, points to one thing.
Booz Allen is trying to stop being what you think it is.
Exactly. The old image, the misconception is that they're just, government consultants in suits.
Right. The people who come in to write a long report or staff a product management office, the body shop model as it's known.
Billing by the hour, filling a seat.
That's the legacy business. And what the sources are arguing, pretty convincingly, I think, is that they're transforming into something new.
The term they're using is a venture integrator.
Which sounds very different. And it is. We're talking about a move from selling people's time to selling actual technology outcomes. And the stakes are huge.
I mean, we're talking about a $400 million investment partnership with one of the biggest names in Silicon Valley.
We're talking about 3D printing drones in shipping containers for the Navy. This is not your grandfather's consulting firm anymore.
It sounds way more like a tech company that just happens to have a ton of security clearances.
And that's the goal. That's the entire pivot. Get the margins of a software company with the stability of a government contractor.
So here's the roadmap for today. We're going to start with the financials, this Q3 reset, to understand why revenue is down but profits are up. Then we'll dig into the business model revolution, the death of the cost-plus model, which is, it's a huge deal.
It's arguably the single most important shift happening in the entire defense industry right now. It changes all the incentives.
And from there, we get into the really futuristic stuff, this threat they're calling agentic AI, and the drone strategy that's being called attritable mass. It's all connected.
It's a very complex puzzle, but all the pieces do fit together.
Okay, so let's jump in. Section 1, the financial reset. As we said, Q3 FY26 revenue, $2.62 billion. That's down 10.2%. But then you look at the non-GAAP EPS, the profit number.
Right, the earnings per share. That came in at $1.77.
Which is not down. It's up over 14%, and it blew past Wall Street's estimates by 50 cents.
A massive beat on the bottom line. So you have this huge divergence, revenue falling off a cliff, profit soaring. It seems impossible.
So what's the story here? How do you explain that?
Well, the first piece of the puzzle is context. You have to remember what was happening in Washington, D.C. at the end of last year.
The historic government shutdown feels like ages ago, but that was just last quarter.
Exactly. And on the earnings call, management put a specific number on that. They said the shutdown directly cost them about $50 million in revenue.
Just gone. Because your only client shuts its doors.
You can't send your consultants to work if the building is closed. You can't bill for the time. So that accounts for a piece of the drop right there.
Okay, but $50 million is just a fraction of the total decline. There's got to be more to it.
There is. The second, and I think more strategic factor, is what they're calling the civil sector reset.
Civil sector. So this isn't the Pentagon. This is work for who? The IRS, NASA.
Exactly. Homeland Security, Health and Human Services, all the non-military government agencies. And that business was down 28%.
Wow. 28%. That's not a reset. That's a collapse.
It's a huge contraction. But here's the key, and this gets to the heart of their strategy. The sources argue this is intentional. While the top-line revenue was shrinking, the quality of that revenue was improving.
The quality of revenue. Okay, break that down for me. What are empty calories when it comes to revenue?
It's a great analogy. Think of it like this. An empty calorie contract is one where you provide, say, 100 bodies to staff a call center for a government agency.
Okay.
That brings in a lot of revenue, right?
Right.
100 people's salaries plus your markup. It makes your company look bigger on paper.
But the profit margin on that is probably tiny.
Razor thin. You're just a middleman for labor. It doesn't build any intellectual property. It doesn't give you a competitive moat. It's just bulk, and it's a huge management headache.
So they're deliberately letting those contracts go.
They're letting them roll off. They're choosing not to rebid on some of this low-margin work. At the same time, the CEO, Horacio Rosansky, and CFO, Matt Calderone, have been running a major cost-cutting program. They've taken out $150 million in run rate spend.
So they're shedding the fat.
They're shedding the fat to build muscle, and the proof is right there in the margins. Despite a 10% revenue drop, their adjusted EBITDA margins were rock solid at 10.9%.
That's the tell. If this was a company in real trouble, in a death spiral, you'd see revenue and margins collapsing together.
Absolutely. The fact that margins are holding up, even expanding in some areas, tells you this is a controlled demolition. It's a strategic choice.
Now I have to push back a little. That 50-cent earnings beat is massive. It can't all be from cutting costs and shedding bad contracts, can it?
That's a fair point, and you're right. There was another, let's call it a special item that helped them out this quarter.
Taxes.
Taxes. Specifically, the new rules around Section 174.
Ah, yes, the R&D rules.
Yeah.
I'm not going to pretend to be a tax accountant.
No one should. But the short version is that changes in how companies can deduct their research and development expenses, plus some R&D tax credits, gave them a really significant boost to the bottom line. It was a major tailwind.
So a good chunk of that 50-cent beat came from a favorable tax situation, not purely from operations.
Correct. And that's important to understand. You can't build a long-term strategy on tax credits. But even if you strip that out, the underlying operational story is still very strong. They're managing the business for profit, not just for size.
And the new guidance they issued seemed to confirm that. They lowered their revenue forecast for the full year.
Right. They narrowed it to between $11.3 and $11.4 billion, which is a contraction.
But they actually raised their earnings per share guidance for the year to between $5.95 and $6.15.
Which is a huge signal of confidence from management. They're telling the market, look, the revenue number is going to be bumpy for a bit because of the shutdown and the strategic shift, but we are going to be more profitable than we thought.
So the big takeaway for you listening is this.
Yeah.
Don't see the revenue drop in panic. See it as a company renovating its house. They're tearing out the old, inefficient plumbing and wiring to install something much better.
That's a perfect analogy. And that renovation is all about changing the fundamental architecture of how they make money. Which brings us right to the next section.
Yes, the death of cost plus.
The great villain of government contracting.
Okay, so this term gets thrown around a lot, especially in the DC area. But I think for a lot of people, the real implications aren't clear. So let's break it down. What is a cost plus contract?
In its simplest form, a cost-plus contract means the government agrees to pay a contractor for all of their allowable costs, which is mostly people's time, their labor hours, plus a fixed profit percentage on top of those costs.
So if a project costs me $1 million in salaries and expenses,
the government pays you that $1 million plus, say, a 7% profit. So you get $1,070,000.
okay. Now, if you're the contractor in that scenario, what is your incentive? What does the contract reward you for?
That's the $1 million question, isn't it? The model rewards you for being inefficient.
Right. Because if the project takes more hours, your costs go up.
And if your costs go up, your 7% profit is calculated on a bigger number, so you make more money.
It literally incentivizes you to be slow, to put more people on the project than you need.
It actively disincentivizes innovation. Think about it. If you invent a brilliant piece of software, an AI tool, that can do a job in 1 hour that used to take 100 hours.
You just destroyed your own revenue stream.
You've just eliminated 99% of your billable hours. You've innovated yourself straight into a pay cut. Why would any rational company do that?
They wouldn't. And this explains so much about why government tech projects are famously slow and over budget.
It's the original sin of the system. But Booz Allen is making a very public, very aggressive pivot away from this model.
Towards fixed price and outcome-based contracting.
Which is the polar opposite. In a fixed price contract, the government says, we have a problem. We need you to build a zero-trust cybersecurity architecture for this network. We will pay you $10 million to solve that problem.
And they don't care if it takes you 10 hours or 10,000 hours.
Exactly. The price is fixed. Now, all the incentives are flipped on their head.
Because now, if I have that AI tool that lets me do the job in 100 hours instead of 10,000,
You still get the full $10 million, but your cost just went from, say, $9 million down to $1 million. Your profit margin goes through the roof.
so now you are rewarded for being fast, for being innovative, for automating work.
Now, your revenue is decoupled from your headcount. You can grow your profits without just hiring more and more people.
This sounds great in a presentation, but are they actually winning these kinds of contracts? The sources mentioned a program called Thunderdome.
Yes, Thunderdome. It's the DoD's flagship program for implementing zero-trust architecture across the entire department.
Zero trust. It sounds intense, like something out of a spy movie.
The name is dramatic, but the concept is actually pretty simple. The old model of cybersecurity was like a medieval castle. You had a big wall and a moat or firewall.
And if you got past the wall, you were trusted. You can roam around inside the castle.
Right. The assumption was that anyone inside the network was a good guy. Zero trust throws that assumption out the window. It assumes the attackers are already inside.
So you trust no one.
You trust nothing. Every user, every device, every application has to constantly verify its identity every single time it tries to access a piece of data. It's a much more paranoid, but much more effective way of doing security.
And that sounds incredibly complicated to roll out across the entire Department of Defense.
It's a monumental task. And Booz Allen just secured nearly $100 million in new fixed-price work on Thunderdome.
Ah, so there it is.
And on the call, management was explicit about this. They said that by shifting these tasks to fixed price, they can innovate how they deliver the service and significantly expand their margins.
They're betting on themselves. They're telling the Pentagon, we have the technology and the process to do this so efficiently that we're willing to take the risk of a fixed price.
If you're just a body shop, fixed price is terrifying. Because if you miscalculate and the project takes longer, you have to eat those costs. It comes straight out of your profit.
But if you have proprietary technology, if you have software that automates the work,
then fixed price is a license to print money. And this strategy also explains another move they made that confused some people, the divestitures.
right, they sold off some of their consulting businesses that worked with DARPA.
DARPA, the Defense Advanced Research Projects Agency, the Pentagon's R&D arm, the people who invent the future.
So why would they sell a business that's connected to them?
Because of a concept called Organizational Conflict of Interest, or OCI. For years, Booz Allen acted as a consultant to DARPA. They helped manage the programs, they helped rate the technical requirements for new projects. They were basically the referee.
Okay, I see where this is going.
Yeah.
If you're the referee writing the rules of the game,
You can't also be a player on one of the teams. You can't bid on the contract to actually build the thing you just helped define. It's a conflict of interest.
so by being the consultant, they were locking themselves out of the more lucrative work of actually being the builder.
Precisely. So they looked at the situation and said, we're tired of being the referee. We want to be the player. We want to be the technical performer that bids on the high-tech AI and advanced manufacturing work coming out of DARPA.
So they sold the referee business to free themselves up to compete for the main prize.
It's a huge strategic shift. It's them saying, we are a technology company now, not just a management consultancy.
And speaking of technology, that brings us to the threat that is driving so much of this change. Section 3, the move to productization, and this thing they call agentic AI.
This was one of the most interesting parts of the CEO's remarks on the call. He pointed to agentic AI as the #1 emerging threat that they see coming online by 2026.
We hear the term AI thrown around so much it almost loses its meaning. We think of chatbots. What makes agentic AI so different and so dangerous?
It's a critical distinction. Most of the AI we interact with today is what you'd call passive or reactive. You ask ChatGPT a question, it gives you an answer, it waits for your prompt.
Its tool.
It's a very powerful tool. Agentic AI is different. It's autonomous. It has agency. You don't just ask it a question, you give it a high-level goal.
A goal like find a vulnerability in the U.S. power grid.
Exactly, or infiltrate this corporate network and steal their intellectual property, and then the AI goes off and does it on its own. It formulates a plan, it writes its own custom hacking tools, it probes defenses. When a defense blocks it, it analyzes the block and tries a different approach.
So it's not a person typing commands. It's a piece of software that can think and adapt and attack all on its own.
And it does it all at machine speed, thousands of times faster than any human hacker could.
That's terrifying. How can a team of human cybersecurity analysts possibly defend against something like that?
They can't. It's like trying to catch bullets with a butterfly net. By the time a human analyst gets an alert, wakes up, logs in, and starts to investigate, the agentic AI has already achieved its goal and covered its tracks. The game is over.
So the old saying, it takes a network to fight a network, is outdated. Now it takes an AI to fight an AI.
That's the new reality, and this is where Booz Allen is placing a major bet. They've developed a proprietary product called Velix Reverser.
And let's emphasize that word, product.
Mm-hmm.
This is not a team of consultants they're selling.
No, this is a software as a service, a SaaS platform. It's scalable software.
And what does it do? Malware reverse engineering.
Right. So when a security team finds a new, unknown piece of malware or virus, the hardest and most time-consuming part is taking it apart to figure out what it does. Who wrote it? What is it trying to steal?
That's the reverse engineering part.
And it is painstaking work for highly skilled human engineers. But the metric Booz Allen released for Velix is just staggering.
This is the one that caught my eye. They said a malware analysis task that would typically take a human expert 10 days.
Velix can now do in under 3 minutes.
10 days.
Yeah.
3 minutes. I mean, that's not an incremental improvement. That's a complete change in the state of the art.
It's a phase change. It's the only way to operate at the speed of an AI-powered adversary. And here's the other crucial detail. They launched it this week for general availability.
Meaning anyone can buy it.
Not just their government clients, it's available to commercial clients as well.
So a bank, a hospital, a power company, anyone facing these advanced threats could become a customer.
And that is the holy grail for a company like Booz Allen. Scalable, high-margin, intellectual property-based revenue. Once you've built the software, the cost of selling it to one more customer is close to zero. It's infinitely more profitable than selling one more hour of a consultant's time.
So this one product, Velix, is basically the perfect case study for their entire strategic pivot.
It is. But as you said, they can't invent everything in-house. The tech world moves way too fast. And that's the logic behind what is probably the biggest headline of all.
Section 4, the venture integrator pivot, and that massive partnership with A16 says.
This is the $400 million headline, literally.
Okay, so let's unpack this. Booz Allen announced they are committing $400 million to a late-stage venture fund run by Andreessen Horowitz.
Also known as A16Z, probably the most famous, most influential venture capital firm in Silicon Valley. The people who backed Facebook, Airbnb, Stripe, I mean, the list goes on.
So why is a 110-year-old government contractor from Virginia suddenly pouring that much cash into a West Coast VC fund?
The simple answer is they're trying to solve a problem that has plagued the Pentagon for decades, a problem known as the Valley of Death.
The Valley of Death. It sounds ominous.
It is for startups. The concept is this. A brilliant little company in Palo Alto invents some game-changing technology. Let's say it's a new type of battery that's 10 times more powerful.
Okay. The DoD would love that.
They would. And they might even give that startup a small research grant, $1 million or so, to prove the concept. And the startup does. Everyone is excited. But then comes the next step, getting a real major contract, a program of record.
And that's where they hit a brick wall.
A massive wall of bureaucracy, federal acquisition regulations, security compliance checks. A contract process that can take 2, 3, even 4 years.
A startup can't survive for 4 years without revenue. They'll run out of money.
They die. That's the Valley of Death. They have a great product the military wants, but they can't survive the process of actually selling it to them. So the best commercial tech never makes it to the warfighter.
So Booz Allen is positioning itself to be the bridge across that valley.
They are the venture integrator. Through this deal, they become the exclusive technology acceleration partner for I-16's American Dynamism practice.
What does that mean in practice?
It means they get a front row seat. They see all the amazing technology being developed within I-16's portfolio of companies, and that includes names like Databricks, Shield AI, Anduril.
So Booz Allen doesn't have to invent the next great AI system from scratch.
They just have to identify it within the A16Z ecosystem.
Yeah.
Then they go to that startup and say, we love your tech. We know how to get it through the Pentagon's maze. Let us be your partner.
So they take the startup's commercial tech and they militarize it?
That's a good way to put it. They wrap it in the required security layers. They handle the compliance paperwork. They integrate it into the military's existing networks. They use their century of experience navigating government bureaucracy to clear the path for the startup.
It's a brilliant move.
Yeah.
They essentially get to be the gatekeeper, the trusted guide for the best of Silicon Valley to enter the national security market.
And it's a win-win-win. The startup gets access to a huge new market. The Pentagon gets access to cutting-edge commercial tech years faster than it otherwise would.
And Booz Allen gets to be at the center of it all, taking a piece of the action.
The language they used in the announcement was very specific, co-creating unique commercial tech for national security. This isn't just a passive financial investment, it's an active strategic partnership to build the future.
So they've got the software product side with things like Velix. They've got the pipeline to external innovation with A16Zs. Now let's talk about the hardware, the physical stuff.
The drones.
This is where the suits to swarms idea really comes to life. Section 5, attritable mass and the drone strategy.
This whole section is basically about the military learning the hard lessons of the war in Ukraine and applying them to a potential conflict in the Pacific.
Let's start with that word, attritable. It's a piece of Pentagon jargon, but it's a really important concept.
It just means something is cheap enough that you can afford to lose it. It's disposable.
Right. And for the last 30, 40 years, the U.S. military has done the opposite. We've built exquisite systems.
Very exquisite. The F-35 fighter jet. The Ford-class aircraft carrier. Billion-dollar, sometimes multi-billion-dollar platforms. They are technological marvels, but you have so few of them, and they are so expensive you can't afford to lose a single one in combat.
But then you look at Ukraine, and you see a $500 hobby drone with a grenade strapped to it taking out a $2 million main battle tank.
That's the shift. The paradigm has changed. The future isn't about a few exquisite systems, it's about mass. It's about thousands or tens of thousands of cheap autonomous systems that can swarm a target.
The idea being, if you launch a swarm of 1,000 drones at a ship, the enemy might shoot down 900 of them.
But the other 100 get through.
Yeah.
And that's enough. The math works. But to make that strategy a reality, you need two things.
Yeah.
You need to be able to produce these drones incredibly quickly and cheaply, and they need to be able to work when the enemy is jamming all of your communications and GPS.
So Booz Allen's own venture capital arm, Booz Allen Ventures, has been making investments to solve exactly these problems. Let's talk about the company Firestorm.
Firestorm is one of the coolest examples of this new strategy. Their concept is called expeditionary manufacturing.
And the mental image you should have here is incredible. We're talking about industrial 3D printers operating inside a standard shipping container.
Exactly. Imagine you're on a remote island in the Pacific. A shipping container gets dropped on the beach, you open it up, and inside is a factory that can start printing the airframes for modular drones.
And they can do it fast. The sources say in under 24 hours.
So you're not waiting for a drone to be built in a factory in California and then shipped across the entire ocean on a vulnerable cargo ship. You're manufacturing it right there at the tactical edge.
It completely changes the logistics. If a drone gets damaged, you don't send it back for repairs. You just print a new wing on site.
Or if you need a different type of drone for a specific mission tomorrow, maybe one with longer wings for surveillance instead of a short-range attack drone, you just print the new components you need. It's warfare on demand.
Okay, so Firestorm solves the production problem. But a 3D printed piece of plastic is useless if it can't navigate. That's where the investment in Scout AI comes in.
Right. Scout AI is all about the guidance problem. In any future conflict with a major power, you have to assume that GPS will be unavailable. It will be jammed or spoofed. It's the first thing an enemy will attack.
So your billion-dollar missile or your $1,000 drone suddenly goes blind and stupid.
Unless it has an alternative way to navigate. And that's what Scout AI is building, using something called vision language models, or VLMs.
VLM, how does that work? How does a drone see?
It uses its onboard cameras to look at the terrain below it, the rivers, the mountains, the roads. And it compares that live video feed to a detailed map that it has stored in its own memory.
So it's navigating by sight, like a human pilot would have a century ago.
Essentially, yes. It can recognize landmarks and say, okay, I see that specific bridge in that mountain peak, so I must be at these coordinates. It doesn't need an external signal from a satellite. It's completely self-contained and jam-proof.
That's a massive leap in autonomy.
It's critical. And there's one more piece to this puzzle. Power. They made an investment in a company called SEQC.
Which does quantum computing. That sounds very high-tech.
It is, but the key to that investment wasn't just about the quantum part. It was about the power consumption. SEQC's digital quantum computing chips run on nanowatts of power, not the megawatts that traditional data centers consume.
And if you're operating at the tactical edge in that shipping container factory, You don't have access to a giant power plant.
You're running on a generator. Every watt is precious. So having extremely powerful computing that is also extremely energy efficient is the final piece you need to make this whole vision work.
So you have the printer from Firestorm, the autonomous brain from Scout AI, and the low-power chip from SEQC. It's not random. It's a complete technology stack.
A stack designed for distributed, attritable warfare.
And the most likely theater for that kind of warfare is the Indo-Pacific. Which brings us to their deep historical relationship with the primary customer there. Section 6, the Navy connection.
This was a part of their history I wasn't fully aware of. It's not a new relationship. It literally goes back to 1940.
Before the U.S. even entered World War II.
Right. The Secretary of the Navy at the time, Frank Knox, was worried the Navy wasn't prepared for a global conflict. So he hired the firm, he hired Edwin Booz and James Allen themselves, to come in and help reorganize the entire department for war.
So this relationship is over 80 years old. It's foundational to the company.
It's incredibly deep. And today, the Navy's #1 problem in the Pacific is something they call contested logistics.
Which sounds like a business school term, but in reality, it's about life and death.
It's the tyranny of distance. The Pacific Ocean is unimaginably vast. Your supply lines from the U.S. West Coast to Asia are thousands of miles long, and the ships and planes carrying those supplies are big, slow, and very easy targets for modern missiles.
So in a conflict, you have to assume those supply lines will be cut.
And if you can't get fuel, ammunition, spare parts, and food, your fleet grinds to a halt. You lose.
So this is where the Firestorm 3D printing concept comes directly into play. If you can't ship a spare part, you print it.
It's a direct technological solution to the Navy's biggest strategic problem. But their work with the Navy goes beyond just hardware. It's also about the digital infrastructure of the fleet.
They won a big contract with the Military Sealift Command, almost $100 million.
That's right. And it's for two things. First, bringing modern connectivity to the fleet. Think secure 5G networks and low Earth orbit satellite communications, like a military-grade Starlink on all these ships.
So they can share data in real time.
But maybe even more importantly, it's about using that data for things like predictive maintenance.
Using AI to fix things before they break.
Exactly. A modern naval ship is covered in thousands of sensors, monitoring everything from engine vibration to the temperature of a fuel pump. Booz Allen is building AI models that analyze all that sensor data in real time.
And the AI can spot a tiny anomaly, a subtle change in vibration that indicates a part is about to fail.
It can predict a failure weeks in advance, which means you can order the part and schedule the repair during your next planned port visit instead of having a critical engine component fail catastrophically in the middle of the South China Sea.
It's about maximizing readiness, keeping ships in the fight instead of tied up for repairs.
It's a massive force multiplier. And the final piece is port security. Using AI to scan the software systems that run our ports, the systems that control the cranes and the logistics, to find dormant malware planted by an adversary.
Because a cyber attack that shuts down the port of Guam could be just as effective as sinking a supply ship.
If the ships can't get loaded, the supplies don't move. Logistics is the foundation of military power, and Booz Allen is trying to become the digital architect for the Navy's entire logistics chain.
Okay, so we've covered the financial reset, the business model shift from hours to outcomes, the new tech products, the venture strategy, and the deep customer relationship. Let's bring it all together. Section 7, the investment thesis. What does this all mean for someone looking at the stock?
This is where our sources argue there is a major opportunity, what they call the tech alpha.
And it starts with what they call the valuation reset. Booz Allen, for a long time, was a market darling. The stock traded at a really high premium.
A premium valuation, yeah. Around 30 times its price-to-earnings ratio, which is very high for a government services firm.
But over the last year, year and a half, that multiple got cut in half. It crashed from around 30x down to about 15x PE.
And the analysis in the sources is that during the budget fights and government shutdown fears of 2025, the market just threw the baby out with the bathwater. It looked at any company connected to government spending and sold it off.
They basically started pricing Booz Allen like it was a failing, low-growth, low-margin consultancy that was about to go out of style.
But the argument we've been walking through is that's exactly what they are trying not to be anymore. The market is pricing the old company, not the new one they're building.
So the thesis is that the stock is fundamentally mispriced.
It's trading like a legacy body shop, but it's building the high-margin, high-tech, product-focused business of a software company.
And if they succeed in this transformation, if they really become this venture integrator for the national security world.
Then a 15x PE multiple makes no sense. A successful tech integrator should trade at a much higher valuation. That's the potential upside. That's the asymmetric opportunity.
And what they mean by asymmetric is that the downside feels pretty well defined.
Right. There's a certain floor to U.S. defense spending. The Pentagon is not going out of business. So you have a stable, if slow-growing, base business. That's your downside protection.
But the upside is this breakout potential, this re-rating as a genuine technology company.
That's the alpha. And supporting all of this, despite the temporary revenue dip, is their backlog.
It's huge, a record $38 billion.
Up 2% from last year, even with all the headwinds. That gives them incredible visibility into their future revenues. They know, to a large extent, where the money is coming from over the next several years.
And in the meantime, they're rewarding shareholders. The capital allocation seems pretty strong.
It is. The dividend yield is now around 2.5%, which is historically very high for this stock. They've been buying back their own shares, repurchasing almost 3% of the company in the last year.
And the balance sheet is healthy. They have the financial firepower to keep making these venture investments and funding R&D.
Their net leverage ratio is only 2.3x. They're in a very solid financial position.
So when the sources sum it all up, the verdict is pretty clear.
Risk defined, portfolio protected, with the potential for a significant upside if this transformation thesis plays out the way they expect.
Okay, let's wrap this all up. In our outro, let's go back to the beginning. We started with a paradox. Revenue was down big, but the stock was up big.
And I think we have the answer now. The market, or at least the forward-looking part of the market, is ignoring the noisy, backward-looking revenue number.
And instead, they're looking at the strategic changes. They see a company using a tough year, a crisis year with the shutdown, as a catalyst to accelerate a radical transformation.
They're moving with urgency. They're getting rid of the low-value, labor-heavy, cost-plus contracts that rewarded inefficiency.
And they're replacing that revenue with outcome-based contracts, with high-margin software products like Velux Reverser, and with strategic venture partnerships like the one with A16Z.
It's a complete overhaul of the business model.
So I think the main takeaway for you listening is that your mental model of a government contractor might be outdated. You probably think of a person in a suit sitting in a cubicle in a secure government building writing a PowerPoint presentation.
And that business still exists, but that's not the future. You need to erase that image and replace it with a new one.
The new image is a 3D printer in a shipping container on a remote Pacific island, printing a swarm drone on demand.
A drone that's guided by a vision-based AI that doesn't need GPS, powered by an ultra-efficient chip, and all brought to the military by a company that acts as the bridge between the Pentagon and Silicon Valley.
It's a fundamentally different company. And that leads to a final provocative thought for you to consider. For decades, the defense industry has been dominated by the primes.
The Lockheeds, the Raytheons, the Northrop Grummans, the giants who build the big, exquisite hardware, the jets, the ships, the missiles.
But if Booz Allen is right, if this transformation is successful, and if the future of warfare really is less about the physical platform and more about the software, the AI, and the network that connects everything.
If the value is shifting from the hardware to the code,
then does the traditional prime contractor model start to become obsolete for this new era of software-defined warfare? Could the venture integrator become the new prime?
That is the multi-trillion-dollar question for the next decade of defense.
Something to think about. That's our deep dives on Booz Allen Hamilton's transformation. Risk defined, portfolio protected. Thanks for tuning in.
Thanks for listening.